So there we go. Great. Hello and welcome to today's Trading Spotlight Hot Topic webinar, Trading the DAX with Seasonalities. My name is Jens. I am a professional trader, and I'll guide you through a very interesting seasonal pattern. In fact, seasonal. So in fact, it's a day of week strategy when it comes to the DAX. And there's a very interesting development which you can spot when carefully watching the DAX. In the morning, together with Marcus, I gave some hints into the direction what could be the thesis behind this, the idea behind this, why this is happening. In fact, the short story, well, we could sum all this up and say we can really spot the advantage, whether we should trade the DAX from the long or short side based on the day of the week we have. And this is what we want to dig deeper into in the following minutes. It's in fact a very impressive strategy, one which is not just for intraday day traders of interest, but probably especially for those who have a classic, let's say, 9-to-5 job and just wonder where to enter, where to exit a trade, especially where to enter it. Exiting the trade really takes place at the end of the trading day when Wall Street closes. And where to place the stop. This is everything I want to go in detail through with you, and also share with you some very impressive back test results based on this strategy, similar to what we've witnessed already or went through and several other occasions and several other hot topic webinars when it came to DAX trading, but also S&P 500 trading, FX trading, but also I think we also did one on gold, if I'm not mistaken. And today we want to have a look at another strategy when it comes to the DAX. If you watch this, by the way, now on YouTube, the recording, please leave a thumb up here if you like what you're seeing or will witness in the upcoming minutes. Subscribe to the YouTube channel. Also, please feel free to set a reminder so that you don't miss any of the videos which we're producing for you. This is not just true for the ones I'm the moderator in, but also the ones from Paul and especially Marcus here with his daily morning trading show. And let's dive into today's topic. Let me share my screen here first of all, and the first slide. And so today's topic will be profitable trading of seasonalities in the DAX40. And before we start, first of all, I'd like to introduce Admirals to you here, the broker behind the series, behind all the webinars, making all this possible and offering all this content for free to you. A broker in the industry for over 20 years now. Wait, let me just check here. Okay, everything fine. No, everything fine. Cool. So a broker in the industry for over 20 years now, starting out as a FX and CFD broker with right now over 8,000 financial instruments being offered, but made a step towards a rebranding, respectively, a multi-asset broker, in fact, offering physical stocks. In this context, by the way, I just see that I forgot to insert a very important slide, especially true when it comes to physical stocks. As of now, you can also trade so-called fractionals. So that might be of interest for people saying, hey, I want to save, let's say, 200 euros a month, invest in longer term engagements and then stocks here. And my focus, for example, is on Tesla, let's say, but Tesla is right now trading at 900 USD per share, slightly above that. And so I only have 200 euros or USD, whatever currency you appreciate or what you're using. So I can't buy one Tesla share, not a problem at all, because fractionals allow you to buy fractions of a share of Tesla in this context. So that means let's assume that Tesla trades up to 1,000. It's easier to calculate. Then you have 200 USD. You want to invest. You buy 0.2 Tesla shares, in fact, and can thus in the upcoming 5 minutes, then 5 months, not 5 minutes, 5 months, say 0.2, 0.2, 0.2, 5 times. Then you have one Tesla share available, and you scaled into the trade with fractional. So very great offering, very interesting offering also for savers in this context. This is not just true when it comes to high priced shares, but also if you say, hey, I want to build a diversified portfolio, like, okay, I have a Tesla here on my watch list, but also an Nvidia, let's say, or case of German traders, probably you look at Allianz or Siemens, whatever, and you want to build a diversified portfolio, but you don't have the money to invest here, then to say, okay, I don't know, in this context of 10,000 USD or euro available, but you can now scale it down and buy fractions of these shares and invest in a broad diversified portfolio. So long thing short, multi-asset brokerage available at Admirals. Check out the website, admiralmarkets.com, for further details on that. And now the new offering on fractionals in this context, fully licensed broker, FCA, SISIC, ASIC. Now there's also a regulatory body in Jordan overseeing the business from Admirals. Over here in Germany, we usually refer to Admirals as the so-called DAX expert, since the offering is very, very, very competitive when it comes to the DAX in terms of the overall costs of doing business, let's say. So spread is very tight, but also order execution, speed, availability of the platform, stability in this context, customer support. So you name it, you will definitely have a good choice when giving Admirals a deeper look, and you should definitely take Admirals into account when looking for a broker out there. Further information, as I already said, admiralmarkets.com. And so now, one word, one broker. Let's dig deeper in this context here. Today's agenda and the topic on the strategy and the DAX I want to present to you. So first of all, I'd like to introduce the DAX40, so German index in this context. No big surprise, especially me being located in Berlin in Germany. So the DAX is our a big index. Everyone is focusing on the DAX, and usually once you want to make an impact or being quoted, let's say from the media, or if a journalist calls you and says, hey, you're a trader or you're an analyst or whatever, could you please give us an idea on what the market is right now doing? Especially, could you please give us some deeper thoughts on the DAX? And it's the DAX. So that's why we focus on the DAX in today's webinar. And then I want to define the daily seasonal trading setup here, and also show it to you in the real world. By the way, let me just, I just realized that it's probably the best in this case to not just show you a slide here, but makes perfect sense. Then I just want to also open here the MetaTrader already. And then I will show you the details on this setup here in the real world from yesterday, but also from today. So in fact, yesterday was a highly profitable day for this setup, and I want to then go into further details here on the strategy and on a real world example. So this is the DAX. And let me just already prepare the chart here. So properties for the moving average. This is the one we want to use here. Exponential. And then we take it from there. But before we dig deeper into this, this is the real world setup I will show to you. Then I will give you some details on the profitability of the setup. So a backtest result, which is in fact over 20 years of history we'll look at here. And then I will give you, in the final step, some ideas on how to smoothen the equity curve. Some, especially active traders, might probably say you can easily fully automate this. You really need to sit in front of the screen all day long. You only need to take care once you enter the trade, and if you're not getting stopped, to exit the trade when Wall Street closes. But there's also some ideas probably I could give you here on how to smoothen the equity curve further and increase the overall profitability of the setup. And this is the last step we're going to go through. First of all, but we want to start with who is the DAX, or who is our DAX40 in this case. By the way, let me just type in good afternoon, traders. So here, this is the chat box. If you have any questions, if there's anything you'd like to know, if there's anything which is not clear, please feel free to ask the questions in the chat box here. So let's have a look at the DAX. So the DAX is the German stock index, or in German it's Deutscher Aktienindex. So DAX, it's DAX in this case. And the DAX is a stock market index which consists of the 40 major German blue chip companies which are trading on the Frankfurt Stock Exchange. In short, it's FSE. And the interesting thing in this context is that the DAX itself is in fact not tradable. It's a purely mathematical construct. If you want to trade the DAX, you really have to then not trade it via the Xetra, so where the spot DAX is traded, but you have to go via the Eurex, the exchange where the future DAX is traded. And then here do your trading based on the DAX. And it might be probably of interest for you to say, hey, but we're trading the DAX when it comes to Admirals here in the platform. The reference market in this case is really the future DAX. So this is what it looks at here in this context. And in case of the DAX still, we are looking at a so-called total return index. So which means that prices are taken from the Xetra trading venue, and then the mathematical construct here, the DAX is in this case calculated. And according to Deutsche Börse, so the owner of the stock exchange here, the operator of Xetra in this case, so the DAX measures the performance of the prime standards 40 largest companies in terms of order book volume and market cap. You probably have heard about the DAX earlier, about the DAX30. There was an upgrade which took place last year in September. And we also had a webinar on this topic, by the way, just to give a short reminder here. What happened back then? Probably heard about the story according or when it came to Wirecard and this big let's call it accounting scandal which took place there. So Wirecard, due to the rules of the exchange here from Deutsche Börse, stayed in the index for another, I think, 2 months or so until it was taken out, which is very, very frustrating for, let's say, a portfolio manager who is trading DAX stocks, respectively, and ETF on the DAX, and where you're then only trading 29 out of 30 stocks, while the 30 stocks, in this case Wirecard, was of no value at all. And yeah, that being said, and with Wirecard being deleted, they also changed here the number of companies which are included in the DAX to probably give a better picture of the overall German economy at all. Not really sure if this really took place with what happened there. But still, that was the main idea behind this step then to upgrade, let's say, the DAX30 to the DAX40 in this case. To have an equivalent here in this context, you also can look at the FTSE, for example, 100 in the UK. More stocks, obviously, listed in the FTSE, but also you can have a look at the Dow Jones, for example, Dow Jones 30. Of interest, very interesting here in this context, especially when it comes to market cap and the overall German economy. I listed the Dow Jones here, or I mentioned the Dow Jones because you really can compare the DAX to the S&P 500. Certainly, there's a high positive correlation, but when it comes to getting a picture of the overall economy, I think it's better to look at the Dow Jones here, who's also not really, let's say, a perfect mirror of the overall US economy. In this context, for example, when looking at stocks which are listed in the Dow Jones, you also look, for example, you probably look at Apple here in this context, but Apple has a very small weight of something like 2% or so in the Dow Jones, given the overall, since it's a price index, given the lower price here. On the other hand, if there has no split taking place, then Apple would have the biggest market cap and weight in the Dow Jones. And this is exactly the thing. So market cap wise, Apple is the not wealthiest, but probably, yeah, it's probably the biggest company in the world, and probably the most valuable name based on market cap in the world. Second comes, I think it's Amazon. Amazon is trading above 3,000 USD a share, so it's not included in the Dow Jones since the price index, and it would give Amazon a massive overweight. Same is true for Google. Currently, or right now, there's a split taking place, which will likely result in Google being then included in the Dow Jones, then depending. But all in all, you can already see from a trading perspective, a trading vehicle here in this case, it's very interesting because the DAX or the Dow Jones also have a very interesting intraday volatility, but still they are not really a mirror of the underlying economy in this case, so the US respectively in case of the DAX, the German economy. What time the DAX opens? So in case of the CFD, if I'm not mistaken, it's close to 24/7. I think there's a short window when there's no trading taking place in case of the CFD. I think it's between 11 and 12 German time. So which means like it's 1 hour. I think then it's 10 and 11 UK, respectively GMT right now, if I get this right with summertime. In case of the future DAX, the trading day starts at 2:15 German time, AM, 2:15 AM German time, while the main volume pours into at 8 AM, which is, by the way, one of the reasons why we'll focus on entering the trade at 8 AM German time in this case. And then the market closes with Wall Street at 10 PM. And there's a short window in which there's no trading taking place, and then there's a reopening taking place. The cash markets, etc., DAX, etc. So I was referring to the future in this case. So when it comes to the cash market, you have the etc. open at 9 AM German time, and then it closes at 5:30 PM every day. Yeah, so that's it on the DAX. And so, well, then I want to straight away give the definition here of the setup. We will look at the seasonal setup. So the market in the DAX, market in the DAX, this is the entry. What you do at 8 AM Central European time, you buy market, and what you in fact do is you go long if it's a Monday, a Thursday, or a Friday, and when the DAX is trading above the EMA 40. And if it's a Tuesday or Wednesday, and the DAX trades below the EMA 40 in this case. So every Monday, every Thursday, and every Friday, we consider this a so-called pro-cyclical entry. So trading above the EMA 40 means nothing more. The advantage can be found on the long side. And Monday, Thursday, or Friday, and if we trade above the EMA 40, pro-cyclical, we are going in direction of the trend. While on Tuesday or Wednesday, if we trade above the EMA 11, we are trading the short side. So we can trade counter the overall advantage, which we identify with this exponential moving average, and vice versa, in fact. So if we trade below pro-cyclical, we trade short every Monday, Thursday, Friday, and we trade long every Tuesday and Wednesday. And that's in fact it. So there's no big surprise, or you might probably now shake your head in disbelief looking at this and just say, okay, and you're kidding us, right? So it can't be that easy. Well, you will see the backtest result is astonishing when it comes to this idea. And the idea behind this makes sense, by the way. So if you look at it from a let's say mental perspective or trading psychological perspective, so if you let's assume you have the weekend. And then you say, okay, over the weekend, we're into the weekly close. You see some kind of optimism coming into the market. So there's no risk aversion, but market participants are probably positioning themselves in anticipation of earnings releases the next week, for example, and try to anticipate a move higher. Then you position yourself into the weekly, into the weekend, and you're going long. And you continue to buy into the start of the week. So when we start on a Friday and you start to continue on a Monday, and what you usually see, especially if the move initially started already into the weekly close in the second half here on a Thursday, you usually get to see a so-called extension on the upside, which makes perfect sense. Because if you have 3 days in a row, Thursday, Friday, and Monday here, and you see buying, then the higher the market rises, if it rises, but certainly so. But the higher the market rises, then the more unattractive the risk reward on the upside gets. So usually you see diminishing buying then on a Thursday, on a Tuesday, respectively on a Wednesday, where you see the pull in, the market correcting, and then taking on momentum again out of this corrective move, then from Thursday, Friday, Monday, and seeing it happening over again. The same is true on the short side. So if market participants are selling into the weekly close for whatever reason, let's say there's some kind of risk aversion taking place. Perfect example, you probably have seen it last week with the Ukraine, for example, hitting the news hitting last week on Friday. We already saw some selling pressure happening in the DAX based on the developments around US inflation, for example. Yields spiking higher, the reversal, let's call it, couldn't be seen. So I myself was very positive on this inflation release last week, because I said, well, most of the hawkishness when it comes to the Fed is already priced into the market. Why really should we now expect, even if we see a print above the expectation of, I think, was 7.3 year on year in the US inflation numbers, why really should I expect now the market to continue to drop or price in a more hawkish stance? I think most of this hawkishness is already priced in. So the initial flush was lower. We saw some buying, but then yields really pushed above 2%. And there was some very hawkish comments from I think it was James Bullard in this case, and that really pushed especially US equities lower. And thus there was already selling pressure building, and the selling pressure continued then, especially into the evening on Friday, with the news around the tensions building from military escalation between Russia and the Ukraine. And thus you had already some risk aversion, which hit the market on Friday. And usually you don't plan to hold a position over the weekend then. So what happened on Monday was the selling continued, and you anticipated that already, while then we saw the sharp bounce with the tensions diminishing on a Tuesday, respectively today on a Wednesday. Even though I just saw that we saw some selling happening right now. Let me just check here. I think, yeah. So the DAX is now minus 0.5%. So US equities obviously under pressure. By the way, I haven't seen it, but I think retail sales were just released. I'm not really sure what these numbers were. Let me just check this. So I take this now from a more detailed perspective in terms of, ooh, okay, that makes sense. Okay, so retail sales came in month on month 3.8%, 3.3. Estimate was 2%. Ex auto was 1%, 3.3. Well, this is huge. That makes sense that the market is under pressure. Why? It makes sense because this increases the likelihood that the Fed will hike 50 basis points on the March meeting. So this will be live, by the way, covered. So we will dig deeper here into the Fed meeting on the 16th of March. There will be a live coverage. So usually you have this hot topic webinar now. The hot topic this day will be the Fed, and we will cover it. So retail sales are very strong. So didn't expect that, to be honest. So that makes sense then. That's the first impression now on the market, I have based on what the market is currently doing. Okay, but still, and you see now that the market, especially yesterday, saw this so-called turnaround Tuesday, and this is the idea behind this. What you'd like to know certainly is, when I enter the market here, is now what's the risk for my trade? By the way, let me just here write something down. I need to collect this data for my trading for US equities today. So this is really important. So today it's not just equities, not just marketplace which are of interest, but also potentially some earnings plays which could be of interest. So probably I've seen it. Upstart, for example, saw some strong earnings, saw a sharp gap higher, giving back some gains now in the pre-market, but also Roblox was of interest, very active in the pre-market, 5.5 million shares, being down over 20% in the pre-market because the guidance wasn't that good. Just see minus 2.4, and the third play, which is probably of interest, but not being actively not as actively traded pre-market as Airbnb. So probably this is my potential third play. But mainly the focus will be off UPST and Roblox in this case. So let me just see minus So 0.1. So this is very important for me to keep my checklist here for the plays, so that I'm capable of reviewing the trades afterwards. If I make any trades, that I have a clear idea on which levels to not just look at, but also what were the pre-market parameters. So was there a gap? How much volume was being traded in the pre-market, and so on and so forth. But let's come back to the DAX and the strategy here. So now the question is the stop. If you enter the market long now at 8 a.m., we not enter the market without clearly having an idea on where to exit the trade if the market moves against us. And in this case, what we do is we calculate it based on a purely percentage point basis, respectively, based on the average volatility you can see in the market. In this case, what we do is we have an index reading, let's say, of 15,000 points. And then we calculate 1.1% from this 15,000. Let me just do this. It's slightly more than 150 points, if I'm not mistaken. So 15,000 multiplied with 1.1%. So it's 165. And if we're going long, we place the stop 165 points below the entry price. If we're going short, we place the stop 165 points above. In this case. So if we have a DAX printing at let's say 15,000, for example, you have to calculate this each day based on the index reading here. There's no take profit being placed. So you close the position every day with no overnight risk when Wall Street closes. So shortly before US markets then close at 10 p.m. Central European time in this case. And so in the following here, I have an example to give you a better idea on what we're doing. So let's assume the DAX trades at 16,000 points. And we now calculate these 1.1% from 16,000 is 176 points. And now assume it is Monday and the DAX trades above the EMA 40 in this case. So this is our advantage identifier, let's call it. So we trade above that last closing price was above EMA 11. EMA 40 here. So we trade the DAX then long. We enter at 16,000 points. We place our stop at 16,000 minus 176 points, get 15,824 points, and we close the position if we're not stopped out before at the end of the trading day at 10 p.m. Central European time. So this is how you can imagine this setup to play in the Yes, yeah. Very important. So there's many questions now on the time. So so here CET, this is Central European time. So this is German time. If you look at UK, it's 9. So you then calculate depending on where you're located in the European Union or wherever in the world you're watching this now, right now. So in case of CET, is Central European time in this case, and we are looking at a daily time frame. Yes, exactly. It's the daily time frame we look at here. So it's the daily time frame, and here, where do we trade on a daily time frame in relation to the EMA 40 here in this context? And here's an example how you can imagine that. So that was the screenshot was taken. Yeah, when did I take it? Somewhere in January, obviously, at the beginning of January when we were headed to new all-time highs here in the DAX. And so now it was a Monday, 3rd of January here, we open above the EMA 40. We are obviously long. The blue line, this is the exponential moving average. This is our identifier. If we trade above, we take a long position. If we enter at 15,860, we now find out what's 1.1% to place our stop here in this case. So we have our stop then at 15,685. And then we close the position at the end of the trading day at 16,051 points. That's in fact it. Nothing more, nothing less. And let's now go in a real example here. Let's have a look at what happened today, for example. So I have here now the DAX on the daily chart. So I already zoomed out. And so what do we see? So first of all, today is Wednesday. And on a Wednesday, obviously yesterday was Tuesday, closing price below the EMA 40. So we close below on a Tuesday. We have on Wednesday a short day because we close below. We are not trading. We are trading short in direction of the identifier. But now It's not a short day, it's a long day, because we are trading below. We would go short in direction of the overall advantage, but it's let's call it a reversal day, or however you call this. And so today we are obviously long. So that's how we enter the trade. So that means we have the opening print. Let me just see here. It's some 15,415. Let me just use the editor here. So open. By the way, it's not right, because this is not 100%. We wouldn't want to use here the 8 a.m. candle in this case. So here you go. So this is like 15,458. So 8 a.m. open again, 8 a.m. or let's use UK time then in this case, 7 a.m. UK. You have 15,458. Stop. We have to find out what's 1.1% multiplied with 15,458. So we calculate this. 15,458 with 1.1%. It's 170. So 170 points. Risk. That means our stop, our setup. That's right here. Say the setup is entry long 15,458. Stop is 15,288, right? 170 points. 70, yes, exactly. And exit, well, depends on where we close, if we are not getting stopped. So let's have a look here where the low was. So the low of the day is 15,331. So we are not yet stopped. You can see here. So initially we popped on the open, and then we rolled over and we traded now as low as 15,331, but we were not stopped because our stop is here at 15,288. We can now play the game for yesterday. Yesterday was obviously a very strong day. And as you can see here, obviously we were long yesterday. Why? Well, we closed on Monday, we closed below the EMA 40. It's a turnaround day, or it's the opposite of the overall advantage day, let's say. So we trade below, usually we trade short, but it's a Tuesday or Wednesday, and then we trade the long side. We open the position here at 8 a.m. German time. So yesterday that was, let me just see here. There we go. It's opening, it's 15,052. Okay, so that's today. And now we go entry long yesterday was 15,052. Stop 1.1% from 15,000 divided by 100. Wait a second. 0.11 multiplied with 15,052. You have 165. It's 166, 165.6. So we round this up. It's 166 points. So that means that we have 15,052 minus 166. So this brings us to 15,052. That brings us to a stop at 14,886. And then we have the exit of the position at, obviously we are not stopped. So you can see this here once again. Okay, the low was not below 15,000. So obviously we are not stopped. And then we exit the position with the close of the US equity markets, which takes place, I think here. Where do we have it? 32. So here. So the closing price is 15,428.29. 15,428. So this is the exit, and the overall profit, as you can see it here, yesterday was, well, close to 400 points. That's good. 370 points. No, Yeah, something like that. So the difference between the entry and the exit, obviously. So this just as an example. So now you might wonder, okay, that's great because now you have 2 days. One day already played out. It was a short day. Why was it a short day? Well, one day we traded below. We closed also last week on Friday below the EMA 11. We haven't closed, by the way, above the EMA 11 since the 1st of February, in fact. So now that worked pretty well, pretty nicely, but how did it work, let's say, over the last 12 months, or especially over a longer period of time? Is it probably just, currently an environment which is favorable for the strategy? This is the question you might have. Does this, or put it differently, does this strategy really have an edge? So you might probably wonder, okay, what we did so far was that's no well, this is no rocket science. So let's just like you look at the today's date, or not date, but the day. In fact, it's a Monday, Tuesday, Wednesday, Thursday, or Friday. You look at the DAX, you see it closes above or below the EMA 40, and then you have a rule to enter, exit the trade. You place your stop based on 1.1%, and that's it. So this is not rocket science. This is really, really simple, in fact. And so if you did this now for the last, in fact, here, 20 years. Oh, in this case, okay. So I'm sorry. The screenshot here ends at February 2017. But even during this time span, the last 18 years. So you had obviously every day a trade. Every trading day, once the DAX is open, you have a trade, because you're not skipping any trades here, but you have a trade every day. The hit rate is, I think, phenomenal. It's close to 50% hit rate in this case. And what's even more impressive is, and this is especially true for the days as you can see yesterday here. So these are the days we are aiming for. So you're long, and then you see a strong trending day. They're not happening that often, but they, in this case here, for example, they happen, and if they happen, you want to be part of this move in this case, and they result then in a so-called payoff ratio of 1.22 to 1. That means that the average gain in this approach is 1.2 times higher than the average losing trade, which with a maximum drawdown here relatively of 15%. So that was the max DD when looking at trading this with one unit. In fact, we can call this. So that's the equity curve. So it's not overly impressive. So there are some setbacks, but still it's a rising equity curve with a very, very simple approach. And you're invited to test it yourself. Download the demo at admirals.com, admiralmarkets.com, and download the demo, test it yourself. I think you can see here, you don't need to sit in front of the screen every second. So you enter the trade in the morning, do something, you'll see whether you get stopped or not. And if you're not stopped, you close the position shortly before Wall Street closes. And in fact, that's it. So that could be already the basic strategy, in fact, and how to trade the DAX from a profitable standpoint, at least based on what we've seen over the last 20 years here, close to that. Now we can take this a step further. So you might probably say, okay, what can I do now to probably increase the overall profitability of this setup? So in this case, I'd like to remind you of the overall approach I prefer here, using market technique, or a Dow theory to some extent. So probably if you follow the webinars together with Marcus, you will already know what I'm talking about. So looking for an overall trend, extensions on the upside, on the downside, whether we are trading in an accumulation or distribution area, for example, and then take it from there. So what we know is, to answer that question here at the beginning, how to find an advantage. Well, if you see a series of higher highs and higher lows, that's usually a sign that there's an uptrend. And if you see a series of falling highs and falling lows, it's usually it's a classic definition of a downtrend. So you have already a definition of that. And then what we could do is we could look at the dominating time frame which we trade in. Let's say if we trade on a 50-minute time frame, we look at an hourly chart in this case. And then we are looking at where we trade. So we look, for example, if we're trading in an accumulation or a distribution area, And what we could then do is, in fact, in an accumulation area, we trade aggressively in direction of the overall advantage, in the direction of the overall trend. And if we trade in a distribution area, then if we trade at all, we trade conservatively in direction of the identified advantage. In case of our approach today, which we just learned about, things are not that complicated. We don't need to look at a dominating time frame, but in fact, we look at the daily chart and we just look at where do we stand in terms of the overall advantage. So if you have a trend structure, for example, let me just see whether probably to give you a better idea. Let's assume the following. So let's assume we're trading here. Okay, you can see that here. So there was this crash. Well, wait a second. There we had the crash with Corona and so on and so forth. This whole period here, we traded on the short side. So there was, in fact, plenty of money to be made if we were not stopped. So this is now the thing. You might probably look at this window here and say, well, this is great. So we are only trading the short, not only, but every Monday, every Tuesday, every Monday, every Thursday, every Friday, we're trading the short side. So there was plenty of occasions probably to profit from this environment. The only problem, and that was in fact a big problem, was we have still a stop of 1.1%, and we had sometimes moves of 1.1% within a minute. So that's usually a problem then, and where you have to already start to intervene and probably reduce the position size. Sometimes you get lucky and you see a massive trend, and when you're making, let's say, 500, 600, 700 points on a trending day, on a strong trending day, sometimes you get very unlucky. You get flushed out into the open because the market just drops 2% within like this, and then it pops back up, and you see the market running without you because you're not positioned anymore. But let's assume we have a, let's say, normal market environment with low volatility in this context. Okay, I think usually, can you still hear me? Just to give me an idea. So usually I think everything should be fine. Yes, okay. Okay, let me just see. Everything fine here. So there's some technical issues. Okay, everything cool. Okay, then it's cool. So let's assume here now we have a trending market. So you can see there's an overall relaxation, let's say, in the overall market conditions, and then you see a trend happening here. So within this trend, and if you see such a pull in here after the market pulled in, and you get probably a long signal once we drop back below the EMA, but in an overall uptrend, you tend to probably trade this more aggressively than here. Then you tend to trade it once we are already extended on the upside. The same is true if you have an extension here on the upside, and then you have a Tuesday or you have a Wednesday, and you probably prefer then to trade it more aggressively on the short side if you have a counter signal, because the risk reward on the upside is getting more unattractive. So this is in fact the basic idea here behind this so-called discretionary intervention. And if you understand the concept behind discretionary interventions based on accumulation and distribution area we trade on, you usually get a quite a good idea on how this smoothing of an equity curve in fact could look like in this context. So as I already said, you see a trend, an uptrend, you see an extension on the upside. You trade here in this area. Once you get a pro-cyclical signal, you trade this more conservatively. If you get a counter signal, you could think about trading it more aggressively, since we're then trading it on the short side every Tuesday and every Wednesday, or respectively on a downtrend. On a Tuesday, Wednesday, you trade it on the long side. While if you have the signal being generated here in the so-called accumulation area, you trade it more aggressively pro-cyclical, while you don't trade it as aggressively once we are in a counter environment, because there you usually expect demand to overcome, let's say, supply here quite aggressively. So that's in fact the basic idea, how to smoothen the equity curve. And yeah, I just hope that you got something out of this. Let's sum up. the strategy. So in fact, very simple, again, very simple strategy, very interesting. If you get the idea behind this, it can be really fascinating. In fact, it's not the holy grail of trading. Don't get this wrong, but it's definitely a good starting point. If you ever wondered, how can you get your first steps into trading? I think this is a great strategy to start with, to get a feeling, to understand how to calculate your stop, the position size. You have plenty of time. You have one signal per day, and you can take it from there. You really can calculate, or not just calculate, but first of all, you can collect data you can then work with, and you can build your risk money management strategy on. You can play with this, Monte Carlo simulations, and so on and so forth. So great way to just start and get your feet wet, let's say, and then take it from there. And again, the strategy very simple. You enter the market every day in the DAX40 at 8 a.m. Central European time, depending on your time zone, could be different here. So UK, it's 7 a.m. usually. GMT, I think with summertime, then we have 2 hours or so. Getting a little confused with this, but all in all, it's usually when institutionals coming to the marketplace and trade the DAX here, the future DAX. So it's usually 8 a.m. German time, and you are going long. If it's a Monday, Thursday, or Friday, and if with DAX trades above the EMA 40 in this case on a daily chart, if it's a Tuesday or Wednesday, and we trade below the EMA 40, you're also trading long, because then we have a counter day. The same is true, only the other way around on the short side. If we trade below the EMA 40 every Monday, Thursday, or Friday is a pro-cyclical day, so we trade it then on the short side. If it's a long environment, and we trade above the EMA 40, but it's a Tuesday or a Wednesday where we trade the counter trade. So we take the other side of the trade. Very important all the time, risk money management. So where's the stop? It's usually 1.1% of the index reading in case of the DAX, then below or above your entry point here. And the position, once you're not getting stopped, is hold the whole day. And we close the position for not having any overnight risk, gap risk, and so on and so forth, with the Wall Street close at 10 p.m. Central European time. So German time in this case, 9 p.m. UK, and so on and so forth. And that's it. So here are the contact details. If you have any questions related to Admirals, admiralmarkets.com, again, look at the website for a demo. If you'd like to test this yourself, play a little around with this, get your feet wet, let's say. If you like this, again, leave a thumb up here. If you have comments, questions, please feel free to ask them below the video, and subscribe to the YouTube channel. Here's the risk disclaimer: fully regulated broker in this context. So this is very important. Please read it carefully. And that's it from my end. So all the best. Happy trading. Watch your stops. Talk to you again next week on Friday. I really look forward to it. All the best. See you. Bye-bye.